Good morning, everybody. It is Friday, March 5th, 2021, and the market that started way up today just turned red an hour and a half into the trading day. So let's talk about what's going on in the stock market. I put out a pretty extensive article early this morning that I had started after the market closed yesterday that really prioritizes what we want to do if this correction extends itself and gives us the opportunities that we've been looking for. So as you can see, I put the big QQQ out there because that's probably one of the things that we'll want to get into, or some of the component parts. So we're going to cover the ETFs today that are in the article. I don't really want to put the stocks out there in case we suddenly go viral and thousands of people see our stocks. But in general, we're looking for the same sorts of things that we were looking for a year ago, and we want to take part in these big secular trends. So let's talk about that really quick. In the past couple of weeks, we have obviously been talking about how liquidity is going to slowly come out of the market. I've written several articles about that, and that would drive a correction. Now, what we don't know is, will the correction be a big straight down correction, or will it zigzag? You remember when those articles came out on Seeking Alpha about how this bull market was in the early innings and how the stock market was going to rally because sentiment speaks and the Elliott waves? And you've seen all these other headlines out there from the data-driven guys and everybody else. And everybody is chronically bullish. And that's a good way to hide as an analyst, because the market goes up 70, 75, 77% of the time, something like that. The problem is that when the market goes up, it's an escalator. It's stairs. When the market comes down, it's usually an elevator. And the market can be the whole market, or it can be a market of a particular industry or sector, or just particular companies that the investors in the market are filtering through, separating the great from the good, from the mediocre from the bad. And as we know, because we've been following it now since the pandemic, there are a lot of zombie companies in the S&P 500. So let's take a look at the S&P 500 first. What we know is that we have a fairly large rally here from about 340 that is probably one of the most unjustified rallies ever on a fundamental basis. And yes, I know rallies can go much longer than we can be solvent if we're short. We haven't been shorting anything since November when we took it on the chin with some oil stocks. And we've realized that the liquidity was so powerful that it would take interest rates rising a bit to kill some of that liquidity and a change in the types of bonds that the Fed is buying. So if the Fed changes the duration of the bonds that they're buying, they can realistically tighten up short-term liquidity, which I think Chairman Powell made fairly clear this week that he isn't against. Now, he's not trying to submarine the stock market, but he clearly, to me, is trying to tap the brakes. Tap the brakes without running into a wall. And I don't know that they can do that very well. The stock market, as we've seen, is hyper-reactive. And by the end of the day today, we started up a full point just about on the SP 500, and Dow and NASDAQ was up, and now it's red. We could end up down huge into the close today if this stock market starts to get real concerned about what's coming in the next couple of weeks. The unemployment report was decent today, so it looks like the whole reopening, reflation thing is going to happen. We've been talking about that for a while. Goes all the way back to my prediction last March and April when I said there would be an emergency use vaccine by the end of last year. And nobody thought that would happen. And yet we have it. And now Merck's deal with Johnson & Johnson is going to drive so many shots, so many vaccines into the market that by Memorial Day, there might be enough to vaccinate everybody. Now, that doesn't mean that everybody will be vaccinated by Memorial Day, but anybody who wants to get vaccinated over the summer probably is going to be able to get vaccinated over the summer. And remember what I said, is I said the first day of school next year might be vaccination day. Now, I don't know that we'll have the data on vaccinating kids under 16, but I think there's a good possibility that we do, and there might be a vaccination given to the kids early next year, and they might combine it with a flu shot. They might just make it part of going to school. I think it would be a pretty smart idea. I know you have your anti-vaxxers and everybody else out there who will scream, bloody murder, but at some point, rules are rules. Keeping the group safe is about keeping the group safe, keeping the teachers safe. I think we owe it to them. So there's some interesting things coming. The bottom line is that it looks like if we don't screw up here in the next month or two, probably it's going to be a pretty good summer. But does that mean the stock market should rally? I think that this rally from here to here is just complete overdone. Now, remember, I thought that this was overvalued, and I was right. And then it went down way more than even I thought, because I didn't think we'd go below the 2018 lows. I always thought that there's, an Armageddon scenario, but I'm surprised that we went below the 2018 lows here. And that should concern you that the market is that fragile. So are we going to see a correction into this area? I think almost certainly. Now, it might take a couple tries to get down there, but I think almost certainly we're going to see the lower 300s on SPY, the lower 3000s on the S&P 500. There's going to be a shift out of the crummy companies. The crummy companies are going to have to face the fact that the super easy money is gone for them. And they're on the clock now. 4, 5, 6 years out, there's well over 100 companies in the SP 500. And it's over 200 by my estimation. Companies that are going to have a hard time paying their debts. One of them is Exxon. Exxon is firing people all over the world. They just wrote down Canada. They're forecasting at this point that they won't be raising their dividend for the next 4, 5, 6 years. The reality is that with the activist investors and the fact that OPEC is probably not going to let the price of oil go up much higher. There was a surprise announcement from OPEC a couple of days ago that they were going to keep that 1.5 million barrels off for one more month, maybe. Come April or May, sometime soon, there's another 1.5 million barrels going on the market from OPEC. This last month, with 1 million of those barrels being voluntary from Saudi Arabia, the rest of OPEC's going to cheat. Russia already cheats. Iran's already cheating. Iraq has cheated on and off. It's coming. So the price of oil is going to be capped right around where it is, 60-ish. And that's going to be really bad for companies like Exxon and all the frackers, with the exception of the few frackers that we've identified, which will hang on until the end of the oil age. Pioneer probably being the one most likely to do well. Devon Energy has had a pretty good turnaround. I'm legitimately surprised that they've been pulling it off, but they still have a lot of debt. Occidental, I don't know what kind of a deal they're going to cut with Berkshire Hathaway and Carl Icahn, but at some point, Occidental has to pay their debts as well. And I think that comes with some sort of deal with Buffett, I think. We'll see. We'll see. She went out there to cut a deal with him before. I think they'll cut another deal. I don't know how that will look. I think it'll be better for Berkshire than for Occidental. In fact, it wouldn't surprise me to see Occidental become a part of Berkshire, because then they could hide a lot of how bad it was. We'll see. We'll see how that goes. In any case, I'm not really fired up about buying this index, but this is something to keep track of, to know about when the market is more fairly valued. So in this area, enough stocks will have come down by then that for sure you can start cherry picking stocks and start buying ETFs. So use this as your benchmark to know, okay, S&P 500 is going down. It's not oversold yet, but when it gets to oversold, then we have to decide what we're going to do. And this is a daily chart. So oversold is likely, and then a little bounce, then it'll be oversold again. See how this worked? And that time period there, the times when it stays close to oversold is when the weekly chart gets oversold. So this was the pandemic, right? We had a horrible month, and that pulled the weekly charts down, which really signaled a pretty good buy opportunity. So here's your weekly chart. I don't know that we'll get this low again, right? But I think that this is something that could happen. And then take a look at 2015-16, where it got down there once, twice for an extended period, 3 times for an extended period. then one last little gas off, and then it went on its bull market run for a long time. So if we get this pulled down to close to the line where it's oversold, it's really going to represent a lot of buying opportunities. And I still think the target for 2024, your 3, 4, 5-year target, 3 to 5 year target. So it could be 2023, could be 2025, but your 3 to 5 year target is about 500 on the S&P 500. So to make this a good return, for them to be able to talk about a 30% return year, this needs to get pulled back, right? So they need to let the market come down. The Federal Reserve is talking about that. I could see this having a couple of years jitterbugging and then taking off in year 3 and 4 of the presidential cycle, which is fairly typical. And by then, a lot of the stimulus money on the business side and a lot of the small businesses will be doing pretty well, I would think. So what do we want to buy from the ETFs? Technology is still king. So we're going to want to get into QQQ. Oops, I'm sorry. Well, that's supposed to be a QQQ chart. So let's pull a QQQ chart up. So technology is still king, and QQQ is a little over half technology. Depends how you define things now that they're calling certain stocks that used to be called technology communications. That was so they could pump up their communications ETF over at S&P. So we're getting this correction. And last week I put the red arrow here to get it down to about this level, 240-ish. And suddenly it came down pretty hard, and it actually just generated a buy signal this 2 mornings ago. And I think that probably was that one little bounce, and you're probably going to see a little red arrow. So these arrows usually are a little early. Sometimes they're right on the money. A lot of times they're early. Like this was a bad signal from the Bollinger Band. It rode along the top of the Bollinger Band a long time. It's unusual. So you can see where you have some of the false signals here in the last couple of years. 3 of them, 3 false down signals. How can that be? It's because it's been a very unusual market. When you back test these, they're usually pretty on the money. But in the era of easy fed money, a lot of these signals haven't worked. That's made the market harder to deal with. Now, if you really don't know what you're doing, it doesn't matter. You just gut it out, and you can gut it out pretty well when everything's going straight up. I've told you the story about my brother and I when we worked at a firm that is now a very big firm. We helped start it. It is funny to us that when the market's going straight up, and this is not a new phenomenon, people think that they're really smart, that they're stock market geniuses. And then the market goes down and it's somebody else's fault. So consider that this correction has been a long time coming. This market, for anybody to say that this bull market is in the early innings, and I've showed you the valuation charts over and over again, it's just doesn't make any sense. It's somebody talking their book, trying to sell a newsletter, trying to sell something. I don't know how far this market will come down. There's a couple of logical levels marked by the orange lines, the orange box. We're down to the top of the buy zone, kind of the expanded range, the orange box being what I expect, the yellow being the range, your second standard deviation, as it were. And we got there. And who would have thought that this was going to happen? The QQQ would be under 300 just a few weeks ago when it was over 330. Interestingly, look, it happened to reverse at about a 1.618 line. Now, the 1.5 and the 2.5, the 0.5s aren't really Fibonacci lines, but they're fairly important. They mark a midpoint. And now these 236 lines are more important than certain other lines. And here it is right there, kind of at a decision point. And earlier today, it looked like it was going to bounce, and then it didn't. That probably means we're going to get down to here, 270 something on QQQ. Then we're going to have to take a look at what does the weekly chart look like, right? So we pop this over to a weekly, make it a little bit easier to look at. And I do think that 500 is going to happen eventually, just not for a while. You see, pretty easy to get there. Then this spot right here, that second orange line, that's pretty interesting support. Because if it breaks that, it means something really is going haywire. So this line here, you're going to want to keep your hands on the wheel and your feet on the pedals, because this is going to be a decision point here if it gets that far. Now, I think it would be healthy if it got in here and traded a little while before it broke out. maybe in the fall. It would be very healthy for the market to tread for a couple of quarters, bouncing around in a range, especially a narrow range, because that would indicate support building, right? That would be one of those patterns that time took the froth off, let some sorting out go on, and then as the economy really was firm and you started to get organic growth and people getting back into the labor force and putting money into their 401k again, that could drive the next leg up. So this arrow here would be outstanding if it didn't, if it did something like this. That would be fantastic. Now, from an Elliott wave standpoint, that would make some sense. And there's other wave theories that would make some sense. If you match those up to the relative strength index, that's really the most important indicator. I have still never found anything that works better than relative strength. Money flow index is important in the very short term because it indicates to you how strong this is. So MFI will either trail or lead relative strength, and that gives you a couple of days notice on the crowd maybe. So you see the MFI is 42, RSI is 49. MFI is pulling down a little faster because of the volume. So this is volume weighted. And this means with RSI higher, this means that this downtrend is fairly strong because there's a good amount of selling going on. The volume is high. So that tells me to anticipate that we're going to break through this level, probably get down to the middle 270s, and then we'll see what happens. BST is a closed-end fund that we added to our universe recently, and it is cheap for a CEF, for a closed-end fund, and it pays out about a 4% dividend. So if you're a retiree, you very well might want to use this instead of QQQ. I would split it up half and half. That's what I've said to do, but if you want to go with this, I think you're fine. This is coming down as well. If we go to a more current chart, today's chart, these guys are selling covered calls, and that's going to mitigate the damage in markets like this. It's the reason that we sell covered calls in our retirement income options. So they have all kinds of premium coming in. A bunch of covered calls are going to expire probably on March 19th, and maybe they have some puts put to them in here. So I'm going to trust that they can use these technical indicators as well as I can. They probably were selling a whole bunch of covered calls up here for these couple of weeks when I was telling all of you to do it. Then as this comes down, they'll start firing off with the cash secured puts. And the fund is only about 30% leveraged. So that means that they can have essentially a full position in QQQ and sell options. If they manage it well, which they have, because we can compare it to QQQ and it's pretty close, they've basically tracked QQQ. And its points have done better because of selling the premium. This is a pretty good fund, folks, right? I mean, it's darn close. Depending on your time frame, BST wins. That's the blue line. Not much difference there, right? So would you like QQQ with a 4% dividend? That's essentially what you're getting here. Semiconductors, there was always the idea that these were the cyclical high-risk stocks. I don't really believe that to be true anymore. And again, I should probably move this green arrow over here, just like I did for QQQ. Just got to the top of the buy zone here, down 60 points. Right? When I was telling people this was going to happen, didn't get a lot of belief because I said it in here too, right? So measuring the funny money is hard. When they're putting monopoly money in the world, it's hard to figure this stuff out. But ultimately, look at how often do we hit these fib lines almost right on the nose? One, it means that I'm drawing the right lines. But two, it means that the market is fairly orderly and there's a lot of people using similar signals. So just like in poker, and I tell a lot of poker stories, I've won the tournament 3 nights in a row now. So I'm very happy about that. Did one last night while I was babysitting the Hulk. He helped me. He put us all in with a 3-7 though once, so that wasn't so good. Hits this line, comes down, and now we're at this line. Decision point this morning that started up, and now it's heading back down. So that says it's going to head through here. This 1.5 isn't that important. It's just a way of kind of showing you where things line up. We're probably headed down in here. Probably going to get to about 330-ish on the semiconductors, on stocks. And then we're going to have to start thinking real hard about, do we want to own this? Because the secular trend is on the side of semiconductors. They power everything. It's not as cyclical as it used to be. There happens to be a tight market now because the automotive industry is putting in like 3 times more semiconductors than they did, 5 years ago. Because everything has driver assist now, whether it's gasoline or EV. And you still have the remnants of a trade war with China that probably isn't going to go away. I wouldn't expect it to go away in the next 4 years. If it goes away, it'll be the next president. Joe Biden's not going to cut any favorable deals with the Chinese at this point. Remember, the liberals on the far edge, on the socialist edge, they're pretty stay-at-home too. I don't know that you can consider them globalists in many cases on the economic side. Certainly on social issues, climate change, a lot of other things. But from an economic standpoint, the far left and the far right are both protectionist. And it plays well in elections. It's bad policy. It's a bad idea, but you got 20, 30% of the population at both edges who don't understand that. So you probably have a majority of people in this country who gravitate towards protectionism, and it's always been like that, going back a long, long time. So in the semiconductor space, why it makes a lot of sense to pay special attention there, you've been following the news, that the Chinese are trying to do their own semiconductors. It's going to take them a long time to ramp that up. In the meantime, we're picking companies not to send technology to. Aoi, go right down the list. And China retaliates. That's why MP Materials, and I'll mention that stock, I'm so high on MP Materials. Rare earth processing in America is going to be a big deal. And like I said, there'll end up being 3 processing plants 4, 5, 6 years out in all of North America. Right now there's 1, and it doesn't even have very high capacity. So the semiconductors, if we can get these couple of things, multiple things lining up for that secular trend, less cyclical than normal, a tight market, and by the way, a trade war. So Samsung, right? Taiwan Semiconductor, a lot of these companies are going to be a big deal. And don't discount the idea that Intel, which is still huge, could have a huge rebound in a couple of years when they get into fabrication more so than they are, right? They just entered. I believe Intel is going to be a force in fabrication. It'll take time, but it's going to happen. So ultimately, you'll have Intel fabricating in the United States, and that's part of the whole supply chain moving back here. And this has always been a great winner. Compare it. Semiconductors usually win. You go back pretty far for them not to be in the lead. But in the last decade, semiconductors have won, and especially the last several years as we've moved into the AI age. This is the artificial intelligence age. Artificial intelligence that I use, right? Why don't we search for trade war semiconductors? It's an awful lot of articles covering an awful lot of companies. A lot of people mentioning it. Sort it by relevance. There you go. Not only is it with China, but look at these guys. Japan and semiconductor. Japan, South Korea and Japan disputing over semiconductor manufacturing. This is a big deal. These supply chains could get pretty screwed up, and the winners are going to be huge winners. Sustainability is still the prince, right? This is the king in waiting. I like PBW, not quite PBJ, not quite PBNJ, but PBW, it was way up here in the 130s. I said, wait for it to get under 100. There you go. Might as well leave the comparisons up. Well, I can't do the price if we do that. Right? Felt good. Didn't make sense. When things don't make sense, what usually happens? Something different, right? So this actually blew through these purple lines. I mean, this got way up there. Just completely blew through where it had any reasonable expectation of going. In fact, I'd have to add this line. Look at that. It got almost to a 4.618. These 618 lines are weird. Came back down. So it's down to 87. It's down. Is it down 20 right now? Oh, that's for the week. But it's down over 8 today. It's almost down 10% today. So you see that the weekly isn't quite oversold. The daily certainly is. So there you go. You'd expect a little bounce maybe on Monday. I think you could probably start looking at selling some cash secured puts on this. Real close. If we take a look at, say, $75 puts, so the April 16th $75 puts are already a couple bucks, probably closer to 4 it looks like, which would get you that price down towards 70. I think this is a pretty good buy area. Now we want to wait a little bit. Let's let it get a little bit more oversold, but it's closing in. So if the market ends up down today a lot at the close, right? If it's not rebounding into the close, if it's still heading down, that would generally mean some pretty bad things for Monday. And Monday might be a day that we have to, get our clicker ready. You can always do TAN, but look at a comparison. I've got PBW, iClean, another Invesco, the Global Clean Energy. The blue line is PBW, I believe. No, the blue line is TAN. The orange line is PBW. So they move very much in common. But what you see is that the holdings here are a lot more diversified. So you get a better beta with PBW, and your performance is essentially the same. I'm going to compare it to, there you go. PBW has done better than TAN for a while. There are periods when you can trade TAN and it's a better idea for a trade. But over a longer period of time, PBW is probably the one you want. But again, you'll find time frames where, hey, you want to ride TAN. If you're doing the swing trading, that's where you look. In a more long-term portfolio, you want PBW. It's a little less risky, a little bit more diversified. What have I kept saying that it's going to take to fight off deflation and deal with global inequality, wealth inequality that's driving a lot of angst at both edges and even in the middle? Rebuild the world. That's right. And it's coming. So this Cushing Infrastructure Fund used to be MLPs and energy infrastructure, and they changed it to be everything infrastructure. I showed you the other day that it has cell towers in it and ports and all kinds of stuff. So this is when they changed. They happened to change over right during the pandemic crash. They have some embedded losses. So the tax situation is actually pretty good with this one. Got a rally, drifted down, another rally. So you correct into this zone. These bottom orange lines, if we can get these bottom orange lines, I think we're going to be pretty happy about that. To buy the top orange line or a top yellow line, you want to see a turnaround, right? Not a 1 or 2 day, relief rally, but a legitimate turnaround. And what we really want to see is some chop. We want to see it consolidate for a while. What was a good example of that? So let's go back to our MP trade that we recently did. Put this on the 4-hour chart because the daily chart will do. So a little while ago, I showed you this chart a while back that it was a consolidating triangle. And that meant it was going to probably break out to the upside. And it did, right about where we said it would. It could have gone a little longer. But it popped up. We got this big rally. We had a chance to sell puts. We had a chance to sell covered calls. And now it's coming back to us. So MP gets back down into this area, right around the low 30s. Should be able to sell puts at that point. And if it goes below that, it's an outright buy. Now, if the market gets horrible, it could certainly go down into this area here. 618 line is usually a big deal. You see that it jitterbugged at that point before. So low 20s is a possibility. So if you sell the put when it's in the low 30s, that would probably give you a buy-in price of middle 20s, which is pretty good. There's a 0.5 line. You can probably aim for that. So you get a net price of 25, 26, probably be in good shape. I would imagine this ends up on our retirement income options list again. And we might even do another swing trade at MP. In fact, why wouldn't we? International travel. Love the emerging markets, internet and commerce. So this is the chart. Looks like we're going to come down here. So this will get pushed out. 100-ish is still a target for sure, but it'll take time. Might not be for a couple of years. So that's why you need to buy these corrections and try to reestablish in your mind that making 20, 25% a year is enormous. The idea that you can double your money every year, every other year is not you if it happens, to be honest with you. Not unless you're a really great trader or you pick some really good bottoms. So what we're going to try to do here is amplify our gains by picking some good bottoms. And I've done it a bunch of times in my career. I missed last spring, and I got the gold stocks. That was a double. And we had talked about all those stocks that ended up rallying. And we owned some SunPower, right? That was a great stock. Enphase, sold it early, but had the money in TAN and SunPower at the time. And it worked out about the same. But, maybe we should have put pedal to the metal because the Federal Reserve was there saying, let's goose it. Now the Federal Reserve is saying they don't want to goose it. So we should probably listen to them now at least, if we didn't listen to them well enough before. So if EMQQ comes down into this zone, in the 50s or 40s, probably going to want to buy it. This is maybe the best international fund out there in a sea of mediocre international funds. I looked through closed-end funds and mutual funds and ETFs. I scanned hundreds of securities. And it's tough to find a great international ETF. It just is. Now, you can pick out the country stocks, which we'll do, and trade them for, 3-month to a couple of year periods. But there's just not good buy and hold international investments unless you go out and build your own basket of stocks. And we're global investors, so we have some in there. The ETF that we're using for dividends on the international side, Wisdom Tree seems to be the best one. I've compared it to a zillion things. If we get it down into here, and you understand that the range, the width of the trading range for international is usually wider than the United States. I don't know that we're going to get here and here. I don't know that we'll get a triple bottom, but this one's a little lower than this one. So this one's a little bit higher. So a price right in here, if we can get it at low 30s, that's an awesome diversifier, pays you a good income, and you get to take part in international growth when the dollar comes back down. So right now the dollar is firm. Told you that months and months ago. I said, in September, August, September, if Biden wins, dollar firms up. And here we are, Biden won, and the dollar's firming up. So we're going to rely on supply chains moving over here to goose the economy long term versus doing all these short-term things that were done in the last administration. Now, I will say, the supply chains have started to move already. Had nothing to do with tariffs. It really doesn't. It's all about being closer to your customer and the resources in an age where labor is not the deciding factor anymore for cost because there's so much automation. So now you just want to go where you can trust the government not to screw around with you. United States or China. Yeah, they're not going to screw around with you too much in the United States. And you can pick on whoever the president is here. Half the population's always doing it. So this pulls down. This is a good one for those retirement portfolios. I wouldn't buy it in a growth portfolio. But in a retirement portfolio, it'll give you the appropriate diversification and a good income. Now, the rest of the article talks about quality stocks and the different stocks that we want to get into. I'm going to skip some of these stocks in the middle because that's not really what I want to show the non-subscribed public. But we could talk about these on Monday, and I'll probably not make that webinar on Monday for the stocks of the week. Won't be public. So if you're watching this, we have a lot of public stuff out there, but you're going to need to subscribe to see the one on Monday because we're going to cover a lot of stocks on Monday. We're going to skip down to the bottom here, talk about the SPACs, because I would love for a lot of people to pile on to the SPACs that we own. And it's a good idea. So if you were slow to get into the SPACs, this is a really good time to do it. These are the prices that I got these at, and almost all of them are down lower than this. So the theory with buying SPACs that are pre-deal, right? They don't have a merger set up yet, and close to their IPO price between 10 and 11.50 is what I said over and over again. And I made some exceptions here. And I bought Liberty up at 13.50, and I could have clearly just set the limit order at 11.50, but I didn't want to miss out on it. I can live with the short-term pain. You should buy the whole spread. You don't know which one is going to cut the best deal, and you're going to get some big rallies if you buy all of these. 1 or 2% of your portfolio, not big positions. And the other ones are going to break about even for you. Why? Because they have big piles of money behind them. And if they announce a deal you don't like, you can bail. Get almost all your money back. And now these prices are all lower. So if you haven't bought the SPAC basket that we put together, and there's 3 or 4 more that we'll add, then you want to just have the whole basket. They're low risk with asymmetric upside. That's what you want in every investment. You have to get past the idea, well, I don't know what they're going to buy. Who cares? We don't care. If it's a good deal, it goes up. If it's a mediocre, bad deal, it stays about the same.
and you can just get out for about what you're in. So have if a bunch of these end up being close to even and a couple go to 30, like MP did, you're a winner. You're a big winner. A handful of great investments carry the portfolio. You're giving yourself a chance at a bunch of great investments with very low risk. Now, the three that made deals, MP, we've talked about, I already showed this chart, comes back down into here. It's another buying opportunity and put selling opportunity, and maybe calls. The fast restaurants, right? Fast. I'll tell you, they are going to do really well. And you're getting another chance to buy them super cheap. Honestly, I think this one should be in the 20s already. The deal that they have with the Golden Nugget and with Golden Nugget Dining, right? So Golden Nugget Casino and other affiliates, casinos, and the Steakhouse and Bubblegum Shrimp and Rainforest Cafe and all the other restaurants they own, and the big pile of money they have to fill in the gaps where there's now a need for restaurants because restaurants in certain areas went under. There you go. So I like Fast a lot. I think you're going to regret not owning this one and getting it this cheap. You might never get it this cheap again. So I'd be scaling into this one right now. And then New Providence. Remember that famous fight I had with Citron about Exact Sciences 6-7 years ago? Citron's on my side now. This New Providence deal with Space Mobile is a big deal. AT&T and Vodafone have already signed up to use their satellites, and those satellite networks will expand to eventually cover the whole planet. This company is going to be a big deal. This company is what Starlink wants to be. It's actually better than Starlink. So take a look at this. People that made money on Iridium and a couple of the other similar companies, this is going to be better than all of them, I think. They already have 2 giant deals, Vodafone and AT&T. There's more coming. They're going to be able to deliver 5G wireless without the wireless part. It's going to be through the satellite. So when your cell phone goes outside a tower range, it'll pick up the satellite. They already can do it. It's not coming technology. It exists. It's working. So, we've heard about how we need to get high-speed internet and data out into the rural areas and the countryside and between the towers. This is going to make it happen. These low Earth orbit satellites, I missed a word, are a big deal. There's going to be a half a dozen companies, maybe 7 or 8 or 9, because you can only have so many up there because they have to be at different altitudes. These guys are going to be a big deal. They're out there. They have some first mover advantage. I expect this stock, I think this one could be, I think this could be an S&P 500 stock. If people think that Starlink can do it and these guys are ahead of Starlink, there you go, right? Because of the contracts. As far as the ETFs go for the SPAC, there's 2 of them that I like, but there's an argument for all 3. So I'll write a comparison of the 3 different SPAC ETFs. I'm interviewing Matt Tuttle next week, who's with the new issue, the SPAC new issue ETF. I'm waiting on an answer from Mark Yusko's office. They have reached out to me, and I'd like to interview Mark as well, do a 25-minute interview with all these guys. The argument for the SPAC ETF that's market cap weighted, it's just like any market cap weighted ETF, is that it's kind of a momentum strategy, right? As long as it keeps growing, you're in good shape. Corrections are a little bit more painful. The new issue one is basically half of our SPAC strategy, right? Buy the low-priced SPACs and then see if they go up. You don't have a lot of risk. So that's the lowest risk one. And then the one managed by Morgan Creek is a managed ETF. And if they do it well, it could be like a Cathie Wood kind of thing. If they don't do it well, it could be like everybody else that manages a mutual fund, right? It's just, I know Yusko is a good manager and his firm is a good firm. I've been paying attention to them since when they first hit the scene in the media. So I would take a look at all 3 of them and decide what fits into your strategy the best. I think the new issue one is the one to use, and then pick out specific SPACs that already have a merger that you want to own. If you don't want to pick these out, then use Yusko's fund and let him pick them out. So I would do the fund that has 70 of these in them and then pick out my own. Now, I had already picked out a bunch of these. And something else to consider is a year from now, Are there going to be as many SPACs coming public? Probably not. Now that the money is tightening up a little, now that the liquidity is tightening up a little bit, I don't think the SPAC thing is going to last much longer. I think this is kind of a one and done thing. Probably be done with it this year or next year with all the new issues. And out of those hundreds and hundreds of ETFs, of SPACs that have come to market, some of them will become the next S&P 500 companies. We want to try to figure that out. I think that this one will end up on the S&P 500. I think this one will end up on the S&P 500. I think this one will end up on the S&P 500. That's all I think about when I buy these. Will it end up on the S&P 500? And can I ride it? Can I ride the triple or more that it takes to get there? That's what I want. All right. Any questions before we turn it off? Somebody has posted, a millennial doctor told me yesterday he lost 50% of his portfolio in 2 weeks. Did you tell him to subscribe to our investment letter? I sure hope so. Or give me a call. Will the gold sector fall with SPY? We've talked about that over and over and over again. So welcome to the show. Yeah, it will. But remember, we've talked about the correlation. Correlation of the gold stocks to the S&P 500 is really low. So we go over to our dog sniffing stock sniffing dog. We go to SPY. Okay. So we already had this up. So there you go. Look at the correlation of GDX to SPY. It's only 0.22. It's not much different than bonds. Very similar to corporate bonds, right? So the correlation to the S&P 500 and QQQ of GDX is basically the same as corporate bonds. Pretty low. So while you would expect a lot of correlation in general, if the S&P 500 drops 30 or 40%, you might get GDX to drop that much for like a hot minute, like on the margin call days. And that's what happened in March. So in March, I actually told everybody a week before it happened what was probably going to happen is that people liquidate their investments that have held up to pay off their margin debt. Now, I'm not so sure this is going to be subject to that so much this time because it's been petering out for a while since September. And now it's in the buy zone. So could it go down to here, the upper 20s? Absolutely. Could it go way down here on Armageddon? For sure. I don't anticipate Armageddon. I was more afraid of it last April and May and June when we were being dumb about the reopening and not wearing masks and fighting with each other over, I won't wear a mask. Stand 6 feet closer. In the next few years, because we'll print money again eventually, because the big boogeyman is not inflation. The big boogeyman is deflation. And anybody who says differently is wrong. And they've been wrong for 20 years now, 15 for sure, since the financial crisis. The big boogeyman is deflation. That's what we're fighting. Deflation brought on by demographics, by overwhelming debt internationally, and the disinflationary impact of technology. So all these people running around saying fiat currency, fiat currency, fiat currency, inflation, 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 they don't know what they're talking about. But here's the thing. When you fight deflation, you create acid inflation because you're printing money. That's what we just saw. We fought a huge deflationary wave that was instigated by high valuations, and then the pandemic hit high valuations. So you had a double whammy. I mean, we were going to get a correction anyway early last year, and then it was worse because of the pandemic. We printed a lot of money. And 4, 5, 6, 7, 8 years out, at some point, we're going to have to face the reality that we can't pay for the baby boomer retirement, not just here, in Japan, China, or Europe either. And there will be more counter-cyclical policies, what they call it, more money printing. I've said that helicopter money is inevitable. Because we don't know exactly when that is it in 2 years? Is it in 6 years? I think probably 6, maybe 10. So there you go. At some point, this rally is pretty hard. Gold stocks are buy the dip for at least a few more years. If you own NPAUU and your broker wants to know your position, do you just take the deal? What does that mean, know your position? Do you want to split it up into stock and into warrants? Yeah, that's coming. So I forget which one it is, but one of them you can split as of today, right? So I'd have to look. I don't remember which one it was. But something that ends in U, you can put in your request to your reorg department at your brokerage, and they'll split it up into stocks and warrants. And you're going to have to go through that process several times. And it costs $20 usually. And the reason we bought the U units, the reason we bought the units instead of the stock, is because there was usually a discount on the warrants at that point. So the new issue IPO ETF, is that the symbol SPCX? All three symbols are so close to each other. Is this one Matt's? Yeah, so SPCX is the SPAC and new issue ETF run by Tuttle. That is the one that I think if you don't want to go and buy a whole bunch of IPO stocks yourself, buy his, let him do it for you. You get a lot more diversification. There's 70 holdings, probably gonna be 80 soon. I would rather do it myself and own 10 or 12 at a point or two each. But if you don't want to do that, you just want it done for you, that's fine too. I think I would say the one weakness there is that you own too many. I think the criteria that we laid out is good criteria. Good management, big pile of money, focus on the growth part of the barbell. So I would just buy the basket that I laid out there for you, and then the 3 or 4 more that I'm going to add next week. But if you're going to buy one ETF and it was for this part of the strategy, yeah, SPCX. And if you want it all done for you, what is Morgan Creek SPAC symbol? SPXZ is the Morgan Creek SPAC, and that's the managed one. So if you don't want to deal with any of the SPACs yourself and just have a manager do it, let Mark Yesku's firm do it. All right, then let's call it a day. Have a great weekend. I am going to be a babysitter the rest of the day, so don't expect much from me. And tomorrow I'm doing a little traveling down to Kenosha and Chicago, and then I'll be back to the grindstone on Sunday. Everybody have a great weekend.